Watch any financial news today, and you'll probably hear about another major company announcing record earnings along with a massive stock buyback. Wells Fargo, Microsoft, Alphabet, Apple, Meta, ExxonMobil. The list goes on. Year after year, companies spend tens or even hundreds of billions of dollars buying back their own shares. And these buybacks are much celebrated. They typically accompany record earnings and higher growth. But should shareholders be so excited when a company buys back its shares? A stock buyback at its core is simple. The company uses its own cash reserves to purchase shares of its own stock on the open market, thus reducing the total number of shares outstanding. On a balance sheet, it looks like this. Cash, an asset, decreases. Equity, or shares outstanding, also decreases. But the total value of the company, at least in the immediate sense, doesn't change. No new factories are built. No new products are created. No extra value is added to the company. Just a rearrangement, moving cash out and shrinking the ownership pool. So why do companies do this? Buyouts are announced when a company is sitting on a lot of extra cash and are not doing anything with it. And when a company has a lot of extra cash, shareholders don't like it. Cash is unproductive. It doesn't grow other than the little bit of interest it earns. Shareholders often pressure a company to do something with that cash rather than sit on it. And unfortunately, with the short-term nature of the stock market, most investors would rather have that company give the cash back to shareholders than to invest in something that may not have a quick payout. And currently, the most common way to give cash back to shareholders is a share repurchase or stock buyback. Why buybacks? Buybacks boost earnings per share, or EPS. How does this work? Imagine a small pizza shop. It has $20 in cash. It has 100 shares owned by investors. It earns 100 per year in profit. That means its earnings per share, EPS, is equal to $1 per share. Now, the shop does a stock buyback. It uses $10 of its $20 cash reserves to buy back 10 shares from investors. These shares are taken off the market. Now only 90 shares remain. But the earnings stay the same, still $100 of profit. Now the EPS is $1.11 per share. So what just happened? The company didn't earn more. It didn't open a new shop. It didn't get more customers. It just used cash to reduce the share count, so each remaining share looks more valuable. With fewer shares held by investors, the same amount of profit looks better per share. Many executive bonuses and performance targets are tied directly to EPS growth. Second, buybacks offer a tax-friendly way to return cash to shareholders. In theory, the price per share should increase when a company buys back shares because the earnings per share increased. So buybacks increase stock price quietly, and gains are taxed only when investors choose to sell, often at lower tax rates. Third, buybacks provide flexibility. Companies can announce or adjust buybacks at will, unlike dividends, which create permanent expectations. On paper, buybacks are just another tool to manage capital efficiently. But here's why buybacks aren't just accounting maneuvers. In practice, they reflect the priorities of the entire company. Executive compensation is often tied to EPS and stock price performance. Buybacks can trigger bonuses without real business growth. Regular employees often don't share in the windfall. Wages often remain flat because the additional cash is going directly to shareholders. If a company has billions available to buy its own stock, it raises a question. Were there no better options for using that cash? Research and development, worker compensation, innovation. Did the company have no long-term plans for growth and to compete in the marketplace? When buybacks dominate, it's a sign that the company's leadership has no long-term strategy to continue to grow, evolve, and compete, or cannot convince its shareholders of such a plan. Let's look at Intel, for example, a company that once dominated the tech world. Back in the year 2000, Intel's market cap was around $500 billion. It was at one point the sixth largest company in the world and a dominant player in the semiconductor market with up to 90% of the market share of PC processors. Today, it's worth just $89 billion. It missed out on the mobile market. It missed out on the graphics processor market. It missed out on the AI market. Its manufacturing lagged competitors. Yet, over that same period, Intel spent more than $100 billion buying back its own shares. In hindsight, those buybacks were no different than throwing the money down the toilet. Forget the fact that it could have invested in all the markets it missed out on. It could have invested in more advanced manufacturing. If Intel had simply held on to the cash, did absolutely nothing with it, it would be worth more than double what it is today. But instead of doubling down on R&D, leading in AI, or building future-proof chip architecture, billions went into artificially inflating metrics, while competitors moved ahead. NVIDIA, which was founded back in 1993 when Intel was already dominating the market, invested aggressively in innovation, now has a market cap over $2 trillion. Buybacks didn't just fail to boost Intel, they helped the company fall way behind in the one race it needed to win, all for the short-term desire to boost its share price. So what's the alternative? If companies have excess cash, they could reinvest in growth, more research and development, better products, stronger future profits. Industries are always evolving, and companies that don't reinvest often get passed by competitors. There are plenty of examples of companies that invest in research and innovation and are able to come up with groundbreaking new products that secure future growth. Companies can use cash to reward employees. Compensation aligned with productivity encourages loyalty and innovation. Too many companies make it clear that their top priority is shareholder value, and it's often at the expense of the employees who drive profits. Companies often talk about attracting and retaining employees, but this needs to span the spectrum of employees. Research consistently shows that when workers are fairly compensated, productivity increases, turnover falls, and businesses grow stronger. Finally, cash can be used to build financial resilience. Holding cash helps companies survive downturns and seize future opportunities. Perhaps the executives don't have a clear view today of the future of their industry or what can drive future growth, but if that opportunity does come, companies should be in a position to quickly take advantage before their competitors. I hear plenty of talk about banning buybacks, but you can't ban poor decision making. A better solution is to educate shareholders and incentivize long-term investing. Companies need to resist the pressure put on them by activist shareholders. It's been proven time and again that executives that manage for the long term offer much better returns on investment than those who focus on short-term tactics. As a shareholder, I don't like hearing a company announce a share buyback. To me, it's a red flag. It often means the company's leadership has no clear vision for future growth. They don't understand their business and don't see where the future is headed. They have no confidence to invest in their strategy. It takes money to gain market share, evolve your product, and continue to bring your product to new markets. There's no alignment between employee incentives and company success. Leadership builds a strategy and the workforce executes the strategy. Companies should motivate their workforce to execute to the highest level possible, and increasing shareholder value never motivates people who are not shareholders. And finally, it demonstrates every intention of chasing short-term share price gains through financial engineering, not real innovation. It shows a severe misalignment between the long-term success of the company and executive compensation. It signals the company is more focused on boosting executive pay than building lasting value. Stock buybacks aren't inherently bad or wrong, but they reveal what a company really values, and too often, it's not the long-term prosperity of the business.